Unit 2, Financial Products. Gilts and bonds. Gilts are bonds issued by the UK government. Most governments issue their own bonds. Most gilts pay a fixed rate of interest known as the coupon. Gilts that are due to be redeemed within 7 years are known as shorts. Those redeemed between 7 and 15 years hence are known as mediums, while those over 15 years are known as, believe it or not, longs. Gilts are usually sold in blocks of £100 nominal or par value. Corporate bonds are issued by a company. They can be split into two main classes. Bonds issued by large, reputable companies such as GlaxoSmithKline and BAA are referred to as investment-grade bonds. Those issued by companies with less secure finances are known as non-investment grade, high-yield or junk bonds. High-yield bonds are as the name implies, offer a high rate of interest than investment-grade bonds. Some companies issue convertible bonds. These are bonds that can be converted into a share at a later date. Local authority bonds are issued by local authorities to help fund their spending. They're secured on local authority assets. They have a guaranteed returns and the income paid half yearly, gross, not negotiable. On maturity, the capital is returned. Permanent interest-bearing shares, or known as PIBs. Some building societies have issued bonds known as permanent interest-bearing shares. Unlike most bonds, PIBs have no fixed redemption date. If a building society were to go under, PIBs investors would only get their money after ordinary savings account holders got theirs. PIBs can be difficult to buy and sell as there is only a small market for many of those issued. In addition, you have to invest a minimum amount. This is usually £1,000 for the smaller building societies, but can be up to £50,000. Deposits. They can include instant access accounts, low minimum balance, low interest rates, high interest accounts, minimum balance or minimum notice of withdrawal with a higher rate of higher balances. Money market deposits. They are attractive to individuals with large amounts to invest for a short term. Offshore deposits are available from branches outside of the UK. Interest is payable gross but taxable if you are a UK resident for tax purposes. Since April 2016, both standard and offshore savings accounts pay interest without any tax deducted. There is no advantage in using offshore accounts to avoid paying tax. Taxation on interest. All interest from deposit accounts, current accounts, will be paid gross. The first £1,000 of interest for basic rate taxpayers will be tax-free. The first £500 of interest for high rate taxpayers will be tax-free. Nothing tax-free for additional rate taxpayers. So if you are earning over a certain amount of money and you are a higher rate taxpayer, you will still pay interest on that saving. All tax due on the excess over these limits is payable via the self-assessment scheme. Offshore deposits. This applies to investments in banks based in other countries, i.e. offshore, known as a tax haven because they enjoy better tax rates. Popular offshore venues are countries where pound sterling is a currency, so they avoid currency movements. Jersey, the Isle of Man are examples of this. Investor protection may be less than their UK counterpart. Investment income is paid gross but will be liable to UK income tax and must be declared by UK residents. National savings and investments. There are lots of different ways that people can save money, namely premium bonds, direct saver, direct ISA, income bonds, investment account, and a junior ISA. Now, the product table for national savings changes regularly, but saying that the exam asks that you're aware of the basics of each product. So premium bond again, they're backed by the government. You can actually invest as little or up to a certain amount of money in them, and they will be completely tax-free. They're backed by the Treasury, so your money is safe. An ISA, or an individual savings account as they are known. You can save up to a tax-free amount, so that you have an ISA allowance each year, and you can save money and keep rolling that money into a new ISA each year. Direct Saver, very similar again. However, of course, it just means that it's a savings account, which is pretty much an everyday account. So you can withdraw money when you need to. Income bonds. Again, investment. So of course, it is a bond. Your money is tied up. And of course, it may well not perform the way you'd want it to perform. But again, they normally do offer you a fixed return. So if it's going to be an income bond of 3 or 4%, on maturity, you should earn 3 or 4% interest on top of that. An investment account, very similar to an income bond. However, the investments that you're actually making may well be stocks and shares, or it may well be some other financial instruments that that particular account is linked to. Money market instruments. Now, the money market instruments, there are various different types. You have treasury bills. These are short-term redeemable securities. They're issued by the Debt Management Office or the DMO. They are short-term, usually 91 days. They do not pay interest. They are a zero coupon. Profit is made by buying them at a discount to the redemption value. They are low risk. There's a secondary market provided by banks, no marketplace. They're held mainly by financial institutions seeking short-term home for their excess money. Certificates of deposit. Again, short-term, larger scale funding. They go between 3 to 6 months in term for £50,000 or more. They're issued by banks and building societies, and interest is paid along with repayment of the capital. Bearer securities, which allows the payment to be made to whoever bears the security, therefore can be sold before redemption. Commercial paper is issued by companies who want to raise money for working capital purposes as opposed to issuing corporate bonds. Large amounts are issued. Purchasers being institutions such as pension funds. Rates determined by credit rating of a company. They're issued between 5 to 45 days. On average, they are 30 to 35 days. Company with low credit rating can issue commercial paper if it is backed by a letter of credit from a bank. Fixed interest securities. Bonds are one of the 4 main asset classes, the others being cash, shares and property. At its simplest, a bond is just a loan. If a government, company or financial institution wants to borrow some money, one of its options is to issue a bond. Typically, they'll pay interest or a coupon on a regular basis and then repay or redeem the full amount of the loan, the principal or the nominal value, on a predetermined date, which is the maturity date. Bonds, which are also known as fixed income investments, are riskier than cash, but less risky than property or shares. Consequently, over the long term, you'd expect to return more than cash, but less than property or shares. Investors can buy and sell bonds through a broker, just like shares. The price of the bond depends on many factors. The term bond is widely abused by the financial services industry. You may have heard of terms like savings bond, investment bond, and guaranteed equity bond. The Child Trust Fund and also the government's Help to Buy scheme. Child Trust Fund, a tax-free savings account for children born since September 2002. It was sponsored by the government but run by banks, building societies and other savings companies. The Child Trust Funds are no longer available and the government contribution ceased in 2011. Originally, it was just a £250 voucher and it was given to start each child's account by the government. This reduced to £50 in 2010 and no new vouchers were issued in January 2011 onwards. Children and families receiving full child tax credit received £500, reducing to £100 in 2010. Parents, family or friends can contribute up to £4,368 in a year between the child's birthdays. Money cannot be taken out of the child trust fund once it has been put in. Once your child is 18, they are able to decide how to use the money. Not just one type of child trust fund account. You choose the type of account you want for your child. It could be deposit-based, shares-based, or stakeholder-based. Now, personally myself, my daughter has a shares-based account. And of course, the amount that she actually will get at the age of 18 will differ from that of her friends. And again, it is entirely up to her how she spends that money, whether that goes towards a university education or save for the longer term for a deposit to purchase a property. Now, the government's the government's new Help to Save scheme will give people on low incomes the chance to receive a 50% tax-free bonus on their savings. Eligible savers can put between £1 and £50 maximum each month into their account and collect the bonus after 2 years. If they carry on saving in the same way for another 2 years, they'll claim another 50% tax-free bonus. This account then will be closed. Now, the scheme is only available to residents who are claiming universal credit or working tax credit. But you could potentially be on £1,200 government free money, not too bad at all. Annuities. They're provided by life insurance companies who pay out a regular income for a specified period in exchange for a lump sum from a private individual or from a pension scheme. The person receiving the annuity is known as the annuitant. Now, this, of course, is very similar to equity release. Now, equity release is known as a lifetime mortgage, and of course, it is for people over the age of 55. Now, what a lot of your customers may well do when they do reach an age of 55 or above is consider taking out an equity release product, purely because at that particular time, a lot of high street lenders and a lot of other mortgage lenders will not want to lend money to these particular customers due to their age, purely because by the end of retirement, or when, of course, the end of the loan period, they will reach a certain age, which means they will not be eligible. So, of course, when people do take out equity release, they then want to have that money set aside. They may use it for certain things like holidays or home improvements, but they will purchase an annuity. And that annuity then will provide them with an income. Now, taxation on annuities resulting from money purchase, occupational or stakeholder pensions are all taxed as earned income in the hands of the annuitant. It's known as compulsory purchase annuities. Now, annuities bought by clients with their own money have a capital element which is deemed by the Inland Revenue to be a return of a portion of the purchase price and is therefore not taxable. The remaining interest portion is taxable at the client's top rate, and the purchase life annuities are normally paid net of basic rate, which is 20% income tax on the interest portion. Immediate needs annuities, those bought with the proceeds of a long-term care plan and used to provide care, are tax-free, so long as the payment is made directly to the care provider. Interest rates and annuity rates. Clients do look into the current long-term interest rates available when the annuity is purchased. Annuity rates increase when interest rates increase and vice versa. Once purchased, the amount of the annuity is fixed and independent of interest rate changes. Most annuities are immediate annuities. They begin payment as soon as the purchase price is received. Deferred annuities begin payment after a specified period or at a fixed date or age. Ordinary shares or equities are in effect part owners of a company. To receive a distribution of the company's profits as dividends, to have a say in the way the company is run, you also get the right to vote in meetings and electing board of directors. Investment in shares may be by purchasing them initially when a company raises capital by issuing them, or buying them from existing shareholders on the stock market. Investment in shares cannot be cashed in by selling shares back to the company. They are sold to another investor on the stock market. The price of ordinary shares can go down as well as up and depend on the profitability and dividends of the company, other economic and market forces. So with shares, of course, you're going to purchase at a particular price. It may well be a rate which is high at the time or low at the time. So when a person purchases shares, they do commit to keeping them for a specified set of time so that they can actually achieve the return that they wish to do so. And they wish to actually achieve by selling them at the right time. And they want to actually get themselves to purchase at the right time. Warrants. They give the holder the right to purchase a specified number of ordinary shares of the issuing company. Is at a specified price on or between certain specified dates. They are high risk investments because if the ordinary share price is less than the specified price on the specified dates, the warrant will not be exercised and therefore becomes valueless. Warrants do not receive dividends or interest. Options. An option is the right to buy or sell an investment, usually shares, at a specified price at a future date. An investor pays a price for the option and can choose whether to exercise the option and hopefully make a profit on the share, or sell the option itself at a profit. Like warrants, these are high-risk investments, as small changes in the share value can render the option valueless. Futures. These are similar to options except that there is an obligation to buy or sell at a specified price on a specified date. Futures are available in a variety of financial products as well as commodities, such as coffee and even in currencies, where they can be used as a hedge against movement in exchange rates. Futures are also known as forward contracts. Forward contracts are made directly between two parties and are not traded. Sharesave and share option schemes. Corporate fat cats earning enormous sums have been heavily criticised as late, and much of the blame lies in the boardroom and shareholder resistance to combat the rising salaries of CEOs. There's a backlash, thank goodness it goes against my principles when a CEO of a house building firm earned 47 million in 2017. One answer is shareholder democracy and empowering the workers to own shares and exercise their right in the boardroom and annual general meetings. The Labour Party, to their credit, have jumped on the bandwagon of this recently, but there are already two excellent ways in workers can buy shares in their firm. Sharesave, also known as Save As You Earn. Workers choose a term to save their money into the scheme, either 3 or 5 years. They invest between £5 and £500 each month. They also know the price of the shares when they begin saving, and its price less 20% that they have the option to buy at the end of their term. Now there are two outcomes at the end of the term. The pessimist says they might want to remain underwater, and when the time is up, the price of the shares is less than the original price. So there's no point exercising your right to buy, otherwise you'll be sitting on a loss. You might as well take your money out of the scheme. So Sharesave, the way it works is the money gets deducted from your salary each month, pre-tax. You are then purchasing that into an account in where you buy your shares. And because you are an employee of that particular firm, you get to purchase shares in that firm at a discount rate than what I or somebody else might be able to buy. Now, after 3 or 5 years, whichever term your client chooses, historically, the way you would want it to be is that the price of the shares has increased. That is when your client will exercise the right to buy. And when they do, they buy and they sell, and that is when they make their money. If at the end of the term they find that the amount of money they've put in and the shares have not increased and they are lower than what they bought at, they would actually be making a loss. And at that particular time, they are able to withdraw their money. So in a nutshell, a very, very good option if sharesave is available in a customer's workplace. The optimist prefers to think that at the end of the term, the share price has risen and can then be bought for much less than the current value. So for example, the cost of your shares less 20% was £5, and at the end of the term, the price has climbed to £10. You've accumulated the maximum. For example, £30,000, and this is to buy the shares at £5. So you have 6,000 shares. Result, the shares are worth on the market now for £60,000. You've practically doubled your money with no income tax or national insurance charge. At that time, cash them in and you could be in for capital gains charge. So this is the time to be very careful. You're better off popping them into a pension scheme, better known as a SIP, which is a self-invested pension, or at least an ISA to avoid the capital gains tax. Share incentive plans. Workers can buy shares from their gross salary before tax is deducted. So very similar to paying into a pension plan with a full tax relief, shares usually have to be held for a minimum of 5 years before selling this to avoid income tax and capital gains tax. Sometimes supermarket gambits are used to enhance the number of shares owned. Bog off, buy one, get one free. That is, again, another type of share scheme, which of course a lot of companies do have. Some employers give them away for free, up to £3,600 per year. Structured products. These offer a guarantee of original capital with exceptional interest returns and have been actively marketed by firms to investors looking for high returns. There are 3 types. Structured deposits. This gives interest returns which may vary around the performance of shares or indices or other parameters. Structured capital at-risk product, or known as SCARPs. These are products where the income and the capital can vary against parameters. Non-SCARP products, where the capital is guaranteed except where the share firm goes bust. Derivatives ensure this promise. Enterprise investment schemes. Enterprise investment schemes were introduced by the government to encourage investment in small, unquoted companies. They involve a higher degree of risk than investments in larger companies, such as those traded on the London Stock Exchange. To encourage the investment, substantial tax benefits are given. Venture capital trusts are listed on the London Stock Exchange and provide finance for small, expanding companies with the aim of generating returns for investors. The Stock Exchange. A full list on the stock exchange is available only to those, usually very large companies, who can meet the stringent financial and other requirements laid down in the exchange's rulebook. In addition, they must have been trading for at least 3 years. At least 25% of their share capital must be in the public hand. The Alternative Investment Market, or the AIM. This market commenced trading in 1995 and is intended for new, smaller companies with potential for growth. It effectively replaced the unlisted securities market, or the USM, which ceased trading in 1996. The rules are less strict than for the stock exchange. Investment in companies on the AIM should be considered higher risk. The benefit of access to public finance and on enhancement of the company's profile are advantages of a listing. Off-market trading, known as over-the-market trading or dark pools. Very common with large institutions trading large blocks of shares outside of the market. Investing in shares. An investor buys or sells shares through a stockbroker. The broker acts in effect as a middleman, charging a fee for his services. The broker obtains the shares from the market makers, who are in effect the wholesalers of stocks. They make their profits by trading in stocks and shares. Real estate. Residential property investment is the growth area for private individuals fueled by buy-to-let mortgages. Now there are advantages and disadvantages. Advantages may include a good rental yield and a mature market, along with capital appreciation in the long term. Disadvantages include prices can fall, as well as a rise and large upfront costs. Income tax is due on the lettings income, subject to any allowable deductions such as mortgage interest, repair and replacement and maintenance cost. A house which is an only or a main residence has been throughout the period of ownership exempt from capital gains tax when it's sold. However, property which is not your main residence is liable for capital gains tax. The greatest risk with buy-to-let is being unable to find a suitable tenant. So perfectly, just as we said, there are advantages and disadvantages. A buy-to-let mortgage, of course, very popular in the past, still very popular now. However, home ownership has changed, whereas previously landlords and property investors would purchase property in their own name. A lot now are purchasing in the name of a limited company for tax reasons. And this again, of course, causes further outgoings for that particular individual or the director of that company. So of course, if a client was to actually ask you that they want to purchase a buy-to-let property, then of course that would be the time to have that conversation with them and explain the difference between owning a property in your own name opposed to a limited company name. Commercial property. Now, commercial property does include offices, individual retail shops, shopping malls, shopping centres, industrial units, for example, factories, workshops. You also get hospitality, hotels, leisure resorts. Now, commercial property provides high rental income together with steady growth in a capital value. The main advantages are regular rent reviews, long leases, stable and longer term tenants. Commercial property does not show spectacular growth in value. Interest rates on borrowing for commercial property may be higher than for residential loans, purely because you will find that if you are purchasing a commercial property, you're going to be paying a lot more for that particular property opposed to a residential property. Reason being is you may take over a supermarket which may be of interest to one of the larger chains such as Asda or Tesco's. If that is the case, they will of course want to take it for a longer term, hence of course a long lease, and of course that particular property value will increase because it is then a going concern. From a small supermarket, it's sold to one of the larger supermarkets and they will want to be in that building for a long time. So for the person owning that commercial property, yes, it will be a lot less hassle because they've got a long lease. They know that their property will be looked after by that particular tenant who is the supermarket opposed to an individual, whereas that is the difference. So having a commercial property does have its advantages, but also its disadvantages as well. Real estate investment trusts. I was in Birmingham this week admiring the all-new and shiny shopping complex called the Mailbox. You may have been there. This complex comprises car parking, retail outlets and office spaces, and you can buy shares in it too. £100 buys you a share in the single unit or REIT with an expected return of 5p per share. This is a classic REIT or real estate investment trust, but instead of being a collective investment, just the one asset is inside. Now the REITs are very tax efficient because the firm is not subject to corporation tax. In return, HMRC does demand that they are distributed at least 90% of the property income to shareholders every year as property income distribution or PIDs. Also, they must drive at least 75% of their profit from rent. Foreign exchange with countries. People use their own currencies to purchase goods and services. Sterling in the UK, dollar in the US, euro in Europe. As with any market, prices of different currencies will vary with demand. For example, if there is a big demand for people to buy US dollars, this will increase the price. In other words, you will need more of your currency to buy US dollars. Unit trusts are collective investments established under a trust deed. Trustees oversee the running of unit trusts. Investments are made by buying units from the unit trust managers, either directly or via an advisor, at the offer price and cashed in by selling them to the manager at a bid price. Now, the units are not traded on the stock exchange. Non-mainstream pooled investments. As the name suggests, these are the exceptions. They are pooled investments that don't adhere to the FCA's rules on pooled investments. Now, the FCA authorizes these types of investments, and they are therefore allowed to be sold in the UK. We're typically talking about unit trusts and OICs. Now, the non-mainstream investment unit trusts, traded life policies and such have more investment freedom with providers based abroad and very little investor protection. Well, the FCA doesn't deem them suitable for retail investors and doesn't allow them to be marketed accordingly. Investment trusts are collective investment trusts, but they are not utilised funds like unit trusts. They are public limited companies whose business is investing in stocks and shares of other companies. They are not trusts. Now, investments in an investment trust is made by buying and selling its shares on the stock market. Investment share prices are affected not only by underlying value of the company's assets, as with unit trusts, but also by other market forces. The share price can sometimes therefore stand at a discount to the asset value. Charges tend to be lower than those for unit trusts. And as public companies, investment trusts, unlike unit trusts, are able to benefit from gearing. They are also known in order to further their investment aims, so they have greater flexibility to make use of opportunities. Split capital investment trusts allow investors to have all the income or all the capital rather than having smaller amounts of both. Open-ended investment companies, otherwise known as OICs. Open-ended investment companies are a form of pooled investments which is popular in Europe. Under UK regulations, unit trusts are able to convert into OICs. Investors buy participating redeemable preference shares in the company, which can issue an unlimited number of shares. Shares are traded at a single price. For example, there's no bid-offer spread, but initial charges will be taken. Umbrella funds are common, in which the company invests in a variety of type of shares. New funds can easily be created, and switches between funds are straightforward. The depository oversees the OIC and is similar to the trust in a unit trust. An authorised corporate director manages the investments and buys and sells shares. Individual savings accounts, known as ISAs. A government-backed savings initiative for the masses, giving tax benefits, maximum annual investment of £20,000. Additional permitted subscription, allowing surviving spouse or civil partner to make additional ISA subscription to the value of a deceased ISA holdings. Individuals can split the annual allowance amongst cash, equities, or innovative finance ISAs. Equity ISA may include shares, unit trusts, gilts, OICs, investment trusts, REITs, child tax funds. Minimum age is 18. There is no capital gains tax or income tax on dividends. Individuals can invest in a combination of cash or stocks and shares ISA. So very similar to what we discussed previously. An ISA, of course, is a savings account which is for an individual. You can change it year on year, and you can invest a maximum currently of £20,000. And of course, it is completely tax-free. Now, a cash ISA may come from a building society, a bank account, national savings. Now, the minimum age is 16, and like I said, it is tax-free interest. Now, With withdrawals, you may withdraw at any time, and you can actually top up your ISA during the tax year as well. ISAs and dying. Death is a certainty. Few people know that this will happen to their Instagram account on death, and even fewer what will happen to their ISA. Each year, ISAs have the maximum investment adjusted, but recently the main ISA has stuck to £20,000. Many allow you to withdraw and then top up the same limit. Help to Buy and Lifetime ISAs have strict maximum funding. Little is actually known what happens on death because we all die at some point. On death, your ISA can benefit from additional permitted subscriptions, which allows a survivor to pump money into your ISA for up to 3 years. 180 days following the estate being wound up, if you have stocks and shares ISA. The money invested will still be protected from all income and capital gains tax, so not too bad. However, I'm still not too sure what will happen to my Facebook profile when I die. Endowment assurances. A non-profit endowment. It's fixed premium for a fixed guaranteed sum assured on death or at the end of the term. Very few investment policies are now issued on this basis. A with-profit endowment. For a higher fixed premium, the policyholder gets not just a guaranteed minimum sum assured, but also a chance to share in the company's profits by means of added bonuses. Principles and practices of financial management. They set out how a firm manages its with-profit business, annual certification to FCA that adhere to a document. Customer-friendly document to be made available. Low-cost with-profit endowment. Its guaranteed sum assured is set at such a level that bonuses expected to be added would be sufficient to raise the claim value to a certain level after a specified period. This is normally used for mortgage purposes, with the aim of being that the final claim value should be equal to the mortgage amount. Unit-linked endowment or a unit-linked endowments are suitable for investors who prefer a more direct link to stock market type investments. They're willing to accept more investment risk without guarantees for the chance of making greater gains. Wish to have the control over the particular type of investments for their policy. Unitized with profit endowment. This product is suitable for clients who like the guarantees provided by with profits policies, but who would like to explore the possibility of changing the risk profile of the investment element. Qualifying policies. An endowment policy has special tax advantages. The funds grow and tax is deducted at source. This tax is equivalent to basic rate tax and capital gains tax. No further high rate tax is deducted from the gains made so long as the policy is qualifying. So what is a qualifying policy? Policies are qualifying provided they do not break any one or more of the following rules. First of all, the 10-year rule. Premiums must be paid annually or more frequently for at least 10 years for some term assurances are, however, exempt from this rule. The 2 times rule. Premiums in any 1 year must not exceed twice the premiums in any other year. Premiums must be paid regularly, at least annually. The 1/8 rule. Premiums in any 1 year must not exceed 1/8 of the total premiums due to be paid in the policy. The 75% rule. The sum assured on death must never be less than 75% of the total premiums due to be paid on the policy, or for whole of life policies, 75% of the total premiums due before the 75th birthday. Now, qualifying policies are treated as non-qualifying if they are surrendered or made up within 10 years or a third of term if less. Since 2012, qualifying endowment premiums cannot exceed £3,600 per annum. Now, I know that's been quite a lot of information to take in. However, you will have to recap and go through your text material just to ensure that all of this material, what we've actually discussed today, does sink in, purely because this may well be in your exam. However, of course, it's something which you should definitely be revising on. What are investment bonds? Investment bonds are collective investment vehicles based on unitized funds. They are unit-linked, single premium, non-qualifying whole-of-life policies. Investment is achieved by paying a single premium for the policy. The single premium nominally purchases units in a specified fund or funds, and the subsequent value of the policy is based on the value of these units, although unlike unit trust unit holders, the policyholder does not actually own the units. On death, the policy ceases and slightly enhanced value is paid out. Switching from one fund to another is often allowed without charging the bid-offer spread. A form of income can be taken by making regular withdrawals, small partial surrenders made by cashing in units. These withdrawals are tax-free to basic rate taxpayers, and up to 5% per annum of the original investment may be withdrawn each year without incurring an immediate tax liability. Now, the unused 5% allowances can be carried forward. Taxation. Gains in the underlying funds are charged to income tax, which eliminates any liability for basic rate tax and capital gains tax for individuals. Neither is recoverable by policyholders who are not taxpayers. An additional charge of 20% tax is incurred by higher rate taxpayers on encashment of the bond. Term life assurance policies. The sum assured is payable only if the life assured dies within a specified period. Premiums are normally level even when the sum assured varies from year to year. There is no maturity value and no surrender value at any time. There is no return of premiums if the life assured survive the specified term. The term can be anything from a few months to 40 years or more, but if the expiry date is after the age of 65, it may be better to take a whole of life assurance policy. Level term assurance. Sum assured remains level throughout. Therefore, real value may be eroded by inflation. Level annual monthly premiums or single premiums. The uses: family protection, key person insurance, cover for loans and debts. Pension term assurance. Pension term assurance is virtually the same as level term assurance, except you can get up to 45% tax relief on the premiums. In December 2006, the government spotted this loophole and blocked it. Policies written on or before the 6th of December 2006 still attract tax relief at the policyholder's highest marginal rates. Decreasing term, commonly used to cover loans such as mortgages or hire purchases. The sum assured decreases over the term, either by equal monthly or annual amounts, by irregular amounts, for example to cover the reducing inheritance tax liability due to the tapering relief provisions for a potentially exempt transfer. In line with the reduction of the capital outstanding on repayment mortgages at a special rate of interest, often known as mortgage protection policy. Can be single life policies or joint first death policy. Premiums are lower than for level term assurance. Premiums are level even through the sum assured reduces. Gift inter vivos. It's a rather fancy name for a decreasing term assurance to cover the inheritance tax liability left from a potentially exempt transfer. 7-year term assurance altogether. 3 years level and then drops by 20% each year for 4 years. Just like the liability of a pet. The policy is put into trust for the person who will have the liability. Family income benefit. On the death of the life assured, within the policy term, the company will pay out a series of payments, usually quarterly or monthly from the date of death until the end of the policy term. This method is suitable for dependents who might have difficulty in coping with a lump sum and might spend it all at once, leaving themselves nothing to live on. The payments are treated as instalments of capital and are therefore not subject to income tax. The payments can be commuted into a lump sum, which would be less than the total of the outstanding instalments. Relevant life assurance. A relevant life plan, or an RLP, is a term assured, offering a tax-efficient way of providing death in service benefits to employees. There has to be an employer-employee relationship, so is not available to sole traders, partnerships, or limited liability partnerships. An RLP is an individual policy with the employer as the policyholder and the employee as the life insured. The sum insured, like traditional death in service policies, is set up as a multiple of salary. Most providers offer up to 25 times remuneration for the younger lives, with multiples reducing as age increases. The policy is then written under a discretionary trust, meaning money is paid quickly without probate to the correct people whilst avoiding inheritance tax. On the death of the employee, the sum insured is paid to the trustees, and this in turn is paid to the named beneficiaries. The premiums are paid for by the employer, and the benefit of that is that they are usually treated as a business expense by HMRC. As far as the employee is concerned, the benefit paid won't count towards the pension lifetime allowance, and premiums aren't taxed as a benefit in kind. Whole of life policies. Whole of life policy features are as follows. They pay out policy benefits on the death of the life assured whenever that death occurs. Single life or joint lives, first or second death. Premiums can be payable throughout life or limited to a chosen age or term. It acquires a surrender value, but it's not an investment policy. With profit whole of life policies. It provides a guaranteed minimum death benefit, which is the sum assured, plus a share of the investment profits of the life fund. It's a level premium, greater than for without profit policy with the sum assured. Reversionary bonuses are added, declared annually, usually as an addition to the amount payable on death, quoted as a simple or compound percentage of the sum assured. Once declared, cannot be removed. Terminal bonuses are added, allow for rises and falls in the fund's stock market investments. Added only in the event of a claim. Rates vary from time to time. Interim bonuses added. Reversionary bonuses added to a claim arising between bonus declaration dates. A joint life second death. Usually a whole of life policy in joint names will pay out when the first person dies. Second death is where the second person has to die before the sum assured is paid out. These are ideal to provide a lump sum in the event of spouses both dying and leaving an inheritance tax liability to be paid. This policy is put in trust for the beneficiary so they can receive it immediately and pay off the inheritance tax liability. Income protection or IPI, also known as permanent health. It provides an income during disability caused by sickness or injury. It is available to employees and the self-employed. Some of the benefits. Permanent means that the policy cannot be cancelled by the company. It has a deferred period, usually 4, 13, 26 or 52 weeks, and must elapse from start of disability before benefits begin. Benefits are then paid until recovery, retirement or death. Disability is defined in terms of being unable to work. A typical definition might be unable to follow own occupation or any other for which suited by training experience. Some companies offer limited benefits to housewives. Proportionate benefit may be payable if a lower paid job is taken due to disability. The maximum benefit, usually 50% to 60% of pre-disability earnings, and providers at the top of the end of the scale may deduct state benefits. Protection is for the chosen term ending at or before state retirement age. Premium levels are higher for some occupations. Policies can be pure protection or on a unit-linked basis. Benefits are tax-free for policies affected by individuals. The type of premiums. They are reviewable, they increase over the term, renewable, renewed periodically according to market rises at the time. If they're guaranteed, they remain the same. Taxation. Individuals' plans are tax-free. Company-sponsored plans are taxable as earned income when the employee receives the income. But most are not treated as a benefit in kind, although they are charged as a tax-deductible business expense. Critical illness cover. This pays a lump sum, not income, on the diagnosis of a number of specified illnesses or conditions. Payment of the sum assured is not delayed until death from the illness. The list of illnesses usually includes heart attack, cancer, stroke, coronary artery surgery, kidney failure, major organ transplant, total and permanent disability, but may exclude certain diseases. What can the lump sum be used for? To help make the sufferer's last days, years more pleasant, to enable them to move to more convenient accommodation, to pay the mortgage in part or in full, or to pay for medical treatment. Now, going back just a few years ago, a colleague of mine was diagnosed with a very aggressive form of cancer. At that particular time, her life had come to a standstill. But because she did have critical illness cover in place, money was not a worry for her. Her main concern at that particular time was to get well and to look after her family. So it's very, very critical and very important that when you are advising your clients on relevant protection policy, things like this are taken into consideration. Private medical insurance provides cover for individuals who wish to use private medical treatment facilities rather than the National Health Service. For example, speed up access to treatment. So if, for example, you do have a health condition which you want to be looked at very quickly and you do not want to wait for the NHS waiting list prior to being seen by a physician or a doctor of any kind, you are able to take out private medical insurance, which of course will allow you to be seen a little quicker. Personal accident and sickness insurance. It's actually renewable annually. Company can cancel. A lump sum is paid on death, loss of one or both eyes, loss of one or more limbs, or permanent inability to work again. It may also include cover for temporary disablement or medical expenses. No tax relief is on the premiums, and the benefits are tax-free. Accident, sickness and unemployment insurance. It's had a very bad reputation since the PPI scandal took hold. Payment protection insurance is essentially the same type of policy but can be used to cover any debt. Hence, many people with credit cards have claimed for mis-selling PPI. Now, although PPI, the scandal, has actually pretty much blown over, it did actually take a long time to sort out, and almost every bank in the UK did actually have to remediate their customers, purely because there was actually a exercise that took place just to ensure that, first of all, the policy was suitable, and second of all, was it affordable? And of course, if the client had a demand or a need for the policy. Business protection insurance. The main aim is to protect businesses against the financial consequences of the death or disability of a partner, a director, or employee. The type of cover used could be whole of life, term assurance, critical illness, or permanent health insurance as appropriate. The aim is to enable surviving partners to purchase a deceased partner's share of the business. This is done with life assurance policies. The precise means being determined by the terms of an agreement between the partners. Keyman insurance. Now, you've undoubtedly heard of the tragic story of Emiliano Sala, who was a Cardiff City footballer. The 28-year-old Argentinian footballer who was sadly lost in a light aeroplane accident earlier this year. Awful story, such a young life cut short by catastrophe. So, first of all, you might be thinking, so what does this have to do with mortgages and protection? Lots actually. When we refer to key person insurance, let me explain. Key person insurance is a commercial insurance policy taken out by a company on the life of an employee, whose death would cause financial calamity to the firm. The sum assured would have been enough to compensate them for the loss of the star player the impact his death would have had on the club. Key person insurance is a specialist contract most mortgage advisors won't get involved in, but you do need to know about insurable interest. This principle allows third parties to insure someone else's life and receive the payout if they were to die. Other incidents where insurable interest exists: spouse to spouse, joint borrowers, or partners in business. General insurance. Think general insurance. Think car and home insurance. General insurance is a branch that few mortgage advisors dare to tread. And that is actually a shame. It covers risks that are more numerous than dying. For example, loss of property, cars, house, diamond engagement rings. Loss of others suing you by negligence on your part. For example, a loose slate that injures the postman, or a faulty switch in your new product that maims children, known as liability. For businesses, loss can be insured against employees being sick or dying. Those who owe you money not paying up, known as pecuniary. Your business being non-operational because of, say, a flood or fire, known as business interruption. Buildings insurance. Standard cover on a property insurance typically includes the following: fire, explosion, lightning, earthquake, storm and flood, subsidence, escape of water, oil or frost damage, riot and civil commotion, malicious damage, impact by falling trees, aircraft, vehicles or animals. However, when you are actually advising your clients on what kind of policy would they have a need for, or they may have a demand for, it's important for them to actually read through the terms and conditions, purely because there might be certain types of properties that are not covered, or certain areas of the country where they live where they might actually be more prone to one or the other. So please do make sure that that is actually very strongly advised to all clients, to ensure that terms and conditions are always read. Content insurance. It provides cover for movable items in a property against the same perils as above. Also can include accidental damage to contents. All risks cover protects your personal items such as jewellery and smartphones when you take them outside of your home. Private motor insurance. Third party. The Road Traffic Act 1998 makes this cover compulsory. It covers death or injury to third parties, damage to property and legal costs. Third party fire and theft, very similar. It also covers fire damage to your car and theft. Comprehensive insurance. It adds all of the above and also accidental damage to your car, loss of personal items and windscreen damage. Travel insurance. When all of you have maybe been on holiday, it's something which a lot of you have taken, or you may have it as a complimentary from your bank account. It provides cover for your holiday trips in the event of cancellation, missed flights, medical expenses or legal expenses. Repayment mortgages. Monthly repayments to the lender consist of interest charged on the amount borrowed and also an element of capital repayment. The capital outstanding decreases slowly at first and then more quickly until it's fully repaid at the end of the term. The interest content of the repayment gradually decreases. If interest rates rise, the monthly repayment increases and vice versa. The loan is guaranteed to be repaid at the end of the term, subject to all the correct repayments having been made. An advantage to lenders of the repayment mortgage is that the capital which is repaid each month is available to use for new loans. Interest-only mortgages. The borrower pays only the interest each month to the lender, the agreement being to repay the capital in full at the end of the term. Since no capital is repaid until the end of the term, the interest repayments remain unchanged throughout, except of course they change when the rate of interest changes. Borrowers usually arrange to repay the lump sum by means of an investment vehicle such as a life policy or tax-free cash from a stakeholder pension. If the repayment vehicle is a life policy, lenders often insist on it being assigned to them, although some choose not to because of the extra administration costs involved. Lenders must obtain evidence that the borrower has a credible repayment plan in force, and the regulator has defined a new type of interest-only mortgage for those in retirement which have to have no set redemption date, known as the RIO, or the retirement interest only. However, what you may find is when you do get clients who want to buy an investment or buy-to-let property, a lot of the time these mortgages will be on a interest-only basis. Now, to qualify for an interest-only mortgage for a residential property, it's going to be very difficult, purely because a lot of banks would prefer you to have a repayment mortgage opposed to an interest-only mortgage, as of course they can then reuse the capital. Endowment policies. The most common type of endowments for mortgage purposes were the low-cost with profits version and the unit-linked policy. The low-cost policy is made up of the following: a with-profit endowment on which the estimated maturity value, based on a conservative reversionary bonus and not allowing for terminal bonus, will repay the loan at the end of the term. A term assurance, possibly decreasing term, to ensure repayment of the full loan if death occurs before the sum assured plus bonus have reached the loan amount. The unit-linked policy is made up of a unit-linked endowment which would repay the loan at the end of the term on a state-assured growth rate, with regular reviews to help keep fund growth on target. A term assurance, as above, to cover early death. There is no guarantee that the required value would be reached. Personal or stakeholder pensions. Personal pension are covered in more detail at the end of this chapter. This mortgage is repaid out of the 25% tax-free cash. Unlike the endowment mortgage, pension contributions obtain the benefit of tax relief, and the investment grows virtually tax-free. Additional life cover is required on a level basis to protect against the death of the borrower before the loan is repaid. An ISA. Repayment of the loan is through regular and continuing, usually monthly payments into stocks and shares ISAs, allowing up to £20,000 per annum investment. The tax advantages and restrictions are those which apply to ISAs. Additional life cover is required to cover the early death risk. ISA mortgages bear the same mortgage cost as other types. Variable rate mortgages. As the name states, they can go up or down. A base rate tracker mortgage. It's a variant of this mortgage of the tracker loan. This loan tracks or follows a set interest rate such as the Bank of England base rate. A fixed rate mortgage is exactly what it says, it's fixed. It's fixed and will not change for the initial period, which may be 2, 3 or 5 years. A capped mortgage. Similar to fixed rate mortgages, except the rate of interest charged can fall below the capped rate but not go above during the capped term. Cashback mortgages. A cashback is a sum of money paid by the lender to the borrower on completion of the mortgage. The sum varies loan size and by lender. An offset mortgage, a little bit different again. A variation of the flexible mortgage is known as the offset mortgage. The current account and mortgage account balances are offset against each other for the purpose of calculating interest on a mortgage. This can sometimes save the client thousands of pounds in interest. Shared ownership mortgages. This effectively combines rental with owner occupation. The system is used extensively by housing associations and enables people on lower incomes to progressively become owner-occupiers. A borrower purchases a certain stake, often 25% in a property, with the aid of a mortgage loan, while renting the remainder. The borrower has the option to buy further stakes later, thereby reducing the rental element. The process of increasing one stake is known as staircasing. Buy-to-let mortgages. Previously, buying a property to produce an income was considered by lenders to be a commercial undertaking. Therefore, mortgages on properties intended to be let have attracted higher interest rates than those available to owner-occupiers. Though a buy-to-let mortgage, the rental income you get for the property is used to finance the mortgage. Lenders will expect landlords to use a letting agent to manage the property and for the tenants' contracts to be drawn up as assured short-haul tenancies. Though there have been changes in buy-to-let lending. The increased stamp duty, the 10% wear and tear allowance was removed and replaced by a furniture replacement relief. A continued attack on landlords has given rise to the limited company route, becoming popular with landlords as this keeps some of the tax advantages. FCA regulation on buy-to-let mortgages. Advising on, arranging, lending and administrating consumer buy-to-let mortgages is subject to a legislative framework as set out in the Mortgage Credit Directive Order of 2015. Guarantor mortgages. These simply add a guarantor to the mortgage deed, which gives the lender someone else to call upon in the event of the borrower's inability to pay the monthly instalments. In addition, lenders can offer larger income multiples to enable the first-time borrower to take a larger loan. Guarantors are normally relatives of the borrowers. You can have more than one, but their age mustn't be more than 65, and affordability checks are made on them. For example, a guarantor may well be a parent or a grandparent, or sometimes a sibling. Equity release. Releasing equity out of a property is not something which has only just come about. People have been doing it for years. However, when equity release, we're talking about people typically over the age of 55. Now, there's two types of equity release products available. There are lifetime mortgages and home reversion schemes. Let's talk a little bit about lifetime mortgages. The client takes an interest-only loan secured on their home. Usually no repayments are made, and the unpaid interest is rolled up and increases to the outstanding debt. On death or second death of a couple, the loan is repaid by the estate from the proceeds of the sale of the house. In the meantime, the owners agree to maintain and repair the property. Any increase in the value of the property between affecting the plan and the death accrues to the estate of the deceased. A home reversion scheme. Unlike a lifetime mortgage, the company takes over ownership of the property, but permits the former owner to remain in occupation until death or second death of a couple, who in turn agree to keep the property in good repair. In exchange, the company pays a lump sum, less than the current value of the property, or an income for life. In this case, any increase in the value of the property accrues to the company. Since April 2017, these have become regulated by the Financial Conduct Authority. A further advance from the existing lender, usually over the remaining term of the existing loan. Can be new, plus existing may be restricted to say 85% of the property value. Some lenders may offer further advances only for improvements to the property. A remortgage, which is basically a new lender takes over the existing borrowing and lends an additional amount as well if need be. Secured second mortgages. People who require a release equity for a purpose not related to the property, for example to buy a car or to finance a business deal, may choose a second mortgage. This is an additional loan from a different lender sitting on top of the original mortgage and secured by a second charge on your property. Interest rates are generally higher than the other methods as the lender security is less. If the borrower does default on this loan, the property can be sold and the main mortgage would be redeemed first out of the sale proceeds, then the second mortgage. Unsecured loans involve no security, just a personal covenant or promise to pay. Therefore, higher risk for the lender who charge a higher rate of interest. This is known as a personal loan. Occupational pensions. It's available to those in employment. A final salary scheme is based on the employee's salary on retirement. The longer they belong to the scheme, the greater the fraction of their final salary will be paid. A money purchase scheme involves contributions from the employer and the employee, which is basically your boss and you. The more money that is contributed, the bigger the pension. NEST or National Employment Savings Trust. The government has introduced new legislation which means all companies will have to automatically enrol their eligible workers into a contributory pension plan. Your basic state pension was available for those reaching state pension age before the 6th of April 2016. Someone qualified for a full basic state pension if they had at least 30 qualifying years. If someone had fewer than this, they received a proportion of the full amount. Those reaching state pension age before this date could also have been receiving additional state pension, for example, state earning related pension schemes or SERPs, or state second pension. The new state pension. It applies to those reaching their state pension age on or after the 6th of April 2016. To qualify for any of the new state pension, we need 10 qualifying years either of contributions or credits. To get the maximum amount, we will need at least 35 qualifying years, again through contributions or credits. Deferring the state pension is available, resulting in an increased income when you potentially take the pension. It works out as an increase of just under 5.8% for each full year of deferral. A private arrangement. Private arrangements do include the following: additional voluntary contributions, freestanding additional voluntary contributions, personal pensions or stakeholder pensions or pension term assurance. Additional voluntary contributions, these are paid by employees who belong to an occupational pension scheme and are run by the same people who run the main scheme. They provide extra income to the employee in return for higher monthly contributions. Full tax relief is available at source. Personal pensions. Where you read personal pensions, you should be thinking stakeholder pensions. They are broadly the same. They are available to any UK resident under the age of 75. This is employed people, self-employed people, unemployed people, children, or anybody for that matter. The most someone can contribute to their stakeholder pension is 100% of their annual income, or £40,000, whichever is the lower figure. However, you can carry forward unused allowances for up to 3 years. The pension fund will accumulate free of income tax and capital gains tax on investment gains. You can take your benefit from age 55. You could take up to 25% of your pension fund as a tax-free lump sum. The rest of the fund can be used to buy an income, basically an annuity, which will be taxable. So there you have it. We've come to the end of Unit 2. First of all, yes, it was a lot of information to take in, but please rest assured, all the information that I've actually shared with yourself is going to be in your text material. And it is vital that you do read through that information prior to exam preparation. Only because alongside with what we've talked about today, you do have a lot of material to go through as well. And definitely that will help you have success in your exams.